Well, Andrew, I'm curious to know of all the deals that come across your desk and you see percentage wise. I mean, what would you say? How many are in the green checkbox as opposed to the no? We're going to pass on this.
Less than 1%.
What? What's up, everyone? Want to give a quick shout out to Street.ai, who is the podcast sponsor, as well as a company that I helped co-found. Bold Street is the number one place for finding, evaluating, and connecting on residential real estate investments. We got off-market deals, we got on-market deals. We will help you evaluate those deals automatically and very quickly so you can get a very rapid picture of the best investment properties to invest in any market you're considering. So come check us out at boldstreet.ai. We'll see you over there. Hey, everybody. Welcome to another episode of The Remote Investor. I'm Michael Album, and today I'm joined by a very special guest, a dear old friend of mine, Andrew Davis, who came from the syndication world, but now is doing something a little bit different and is going to be talking to us about what we need to be aware of, some of the pitfalls, and things to keep our eyes open for if we are even going to be considering investing as an LP or in a syndication. So let's get into it. Mr. Andrew Davis, thanks for coming to hang out with me today. I really appreciate it.
It is my pleasure. So good to see you again.
The pleasure is all mine. We're both sick today, of course. So if you're listening to this, you'll probably hear it nasally in our voices. But Andrew, for anyone who might not be familiar with you, your story, your background, give us a quick and dirty who you are, where you come from, and what is it you're doing in real estate today?
Yeah, absolutely. So, my name is Andrew Davis. I've been investing in real estate for 15 years, which is crazy. I just turned 40 and I did my first investment when I was 25. So uh, pretty clean history there right now. And I did it as a side hustle for about 10 years. And I like to say I banged my head against the wall trying to cobble together a single family portfolio because I thought that was the way to go. And I'm not saying it's not, it just wasn't the way to go for me. And
Mm-hmm.
about 5 years ago, I was doing real estate on the side, buying duplexes, single family homes, very small multifamily apartment buildings, and decided that I loved real estate. It turned out that I was not really great at being a landlord. The tenants and toilets things weren't really my jam, but I was really good at finding deals, and I was really good at raising money for those deals. And so I decided to stop doing a W-2 that I didn't really enjoy and go full time on the commercial real estate side. And over the last 5 years, I've worked at two different PE firms in different investor relations capacities. And throughout that time, I've raised about $500 million, a little over $500 million for commercial real estate, apartments, self-storage, car washes, private credit, hospitality, ground up development. I think that's all of it. Industrial. And yeah, about this time last year, I had a vision for a company, and I decided to take the leap and start it. And that company is Equity Check. It's the company that I run now. And in short, we exist to draw attention to great sponsors who otherwise investors probably would never hear about. And we have a really simple but powerful criteria for how we find and vet those sponsors, and then connect deserving investors with them. So that's uh, that's the short story of me and what I'm doing.
I love it, man. I wanted to have you on today because you got to work behind the curtain, so to speak. You were on the syndicator side, on the team of the syndicator, and now you're maybe on the other side of the coin, evaluating said syndicators and then pairing those syndicators with, like you said, would be investors. So I want to know, like, what about, first and foremost, what about being a landlord didn't resonate with you, or did you figure out you weren't good at it, and why? And then secondly is, why didn't you go fix that problem? Why didn't you just go be a better
Mhm.
landlord, go get better at being a landlord?
Yeah, great question. So I think that the probably the main reason I wasn't good at being a landlord was empathy, and
You make all the landlords listening sound like heartless bastards.
I don't mean that at all. I just mean I wasn't a good business person, and man, the story that comes to mind is I I found this great property in Orlando when I was living and investing there at the time, and it was a classic off-market deal. I did the yellow letter thing, connected with the owner, got it at a great discount, renovated it. That was a whole story of its own. Moved in what I thought was a lovely young family, and I say within the first 6 months, there was really a really unfortunate domestic violence situation where they split up, and long story short, because I was I felt all this compassion for the family in that situation. Um, we didn't collect rent for some time, and so and if that was it was just my own funds, I think I would have been okay with that. But I had
Yeah.
investors in the project, and so I just was in this position where um, the yield wasn't very great. Single family home investing can absolutely be profitable, but at that point in the market cycle, there was not enough meat on the bone, and so it wasn't like I was making a ton of money. I was basically paying the appreciation game, and I just ran into that situation over and over and over again where I had a really tough time separating, hey, I really want to care about these humans, and I also need to run a business and serve my investors. So I think that was one reason, and why I didn't enjoy being a landlord. And then I had never found a good residential property management firm. I'm sure they're out there, but I ran through several of them, and I ended up having to do about as much work as when I was managing the properties myself. And then secondly, I love efficiency, and I always have. And so I had the good fortune of connecting with guys that were doing very, very well in the commercial space in different asset classes. And they would kind of tease me. We'd go out to lunch or coffee, and I'd be sitting there, talking about how exhausted I was finishing this last flip or this last Burr deal. And they'd be like, man, I just wrapped up a 200 unit deal and, made 100x what you made. And I'm sleeping great at night. And I was just like, gee, this is not the most efficient way to go about this. And so for those two reasons, I made that shift.
Yeah, no, that makes sense. Okay, I
Hmm.
could buy that. I could buy that. So then you made the jump into helping syndicators raise money.
Hmm.
And so it sounds like you had a network of maybe opportunities to choose from, of different syndicators you could go work with. So how did you make the choice to go work where you did?
Yeah, I talked to a lot of different syndicators, and I think it was really a mix of opportunity. It was a mix of, it was timing. So over the course of about 2 years, I talked to a lot of different syndicators, and a lot of them were in this position where they were starting to do some deals. They wanted to bring somebody on, but they weren't quite ready to bring on a full-time employee. And so it was sort of like, yeah, we'd love to bring you on, but we're not quite ready yet. And so a lot of it was a timing thing. There's a couple different things personally for me that just made a lot of sense. And then the group that I went to go work with, I really liked the principles. I liked their strategy. I liked the scale. I thought they had really, really great materials. And I thought that they were thinking at a level that I didn't see a lot of other sponsors and syndicators thinking at. So I think it was a timing thing, and also I really the vision was compelling to me.
Okay. All right. Well, that makes sense.
Yeah.
And then so what about this vision
Hmm.
made you take the leap and say, "No, I've got to leave doing what I sounds like you really enjoyed helping folks get into commercial real estate to
Hmm.
now go doing something on your own with this equity check thing?"
Yeah, it's such a great question. So, man, as you do when you step into a new space, you really you don't you're learning so much. You're really understanding. You get a map. You like start out with a really fuzzy map, and then the longer you're in it, you really start to understand the territory. And what I saw in the space was a lot of really new to the game sponsors and syndicators that, quite frankly, through some mixture of either incompetence or lack of character, were not operating in investors' best interest. And there have been countless stories and countless investors that are in really bad situations right now because sponsors and syndicators got them into bad deals where they're not receiving distributions, where they're losing money, where capital calls are being made. And not only is their return at risk, but potentially the entire principal of their investment. And not only did I hear a lot of stories about that, I also experienced that personally. My family experienced that. People that I care deeply about experienced that. And so it really became it was a mission oriented thing as much as anything else, because while I was in that space and I was seeing all this happen in what I would call um, the podcast circuit, and nothing against podcasts. We're on one right now. I think podcasts are great, but there was this
Hype.
model that emerged, that it was like, if you go out there and you talk to people about how to invest in real estate, then everybody's going to think that you know how to invest in real estate. And therefore, you'll become the expert. And it was sort of this kind of like fake it till you make it authority, thought leadership marketing thing. And
Hmm.
that's fine if you're actually an authority and you actually have good thoughts, but a lot of folks didn't. And probably the most ironic thing that I know of, although I'm sure there's plenty, is there's a group out there that wrote a book with some, I won't give too much away, but something like the ultimate authority on multifamily investing. And meanwhile, this group, most of their deals have paused distributions. They've made multiple capital calls, and their deals are not performing well at all. So there's a lot of that out there in the space. And at the same time, I was seeing that with groups that seem to be great at marketing and sales, not great at operations. I'm not great at stewarding investor capital. I had the good fortune of connecting with a lot of groups that I and anybody that I had met in this space, a lot of investors had never heard of, but they'd been operating for decades. They had impeccable track records. They had just been very, very quiet and focused on finding and operating great deals. And they were structuring those deals in a way that really prioritized their investor interests. And I thought, oh my goodness, these are the people that need attention, and these are the deals that people should be investing in. And so that was the genesis and the impetus for Equity Check.
Man, I love it. I remember, so full disclosure, you and I kind of go way back,
Hmm.
and I remember when you were telling me about this idea, equity check. I'm like, this is genius. And so, because I think to your point, there are so many investors, especially newer investors, will hear someone talk, and they're claiming to have done a bunch of deals, or they have done a bunch of deals, and so clearly they know more than me, the investor, and so
Hmm.
I will listen to them. Who
Yeah.
am I to say they don't know what they're talking about? Who am I to call their BS? And so it sounds like you are now kind of stepping into that role on behalf of the investors to say, wait a minute, let's not move so fast here. Let's make sure we're evaluating A, B, and C, so that way, investor, you're not getting taken advantage of. Is that part of what I'm hearing?
100%. Yeah, 100%. And there's a couple quotes that I think are, or kind of funny quips from legendary investors, Warren Buffett and Charlie Munger, that I think like really epitomize this. The first one that I think is so funny and so true is basically, it's don't ask the barber if you need a haircut. And
Yeah.
so there's people that will put out like the ultimate the ultimate due diligence checklist for investing in real estate, and it just so happens that this due diligence checklist checks every single box on there for them, but
Right.
conveniently leaves out things that don't make them look good, or that actually are areas of concern.
Hmm.
And the second piece is from Munger. He says, "Show me the incentive, and I'll show you the outcome." And so there's just, yeah, it's really number one. I think it's a really really challenging time for anyone, really in any arena, to sift through what is good information and what isn't. And so, yeah, the hope is just to help people do that and provide a useful framework, whether they ever invest with us or not, for sifting through everything that comes across their desk when it comes to passively investing, whether it's in real estate or venture, or small businesses, whatever it may be.
Yeah. No, that makes sense. And I love those quotes. But so let's take Charlie Munger's quote and turn it on you for a second. So
Yeah,
what's your incentive? I mean, I know you. I know you're a good person. I know you've got stand-up morals and values. But
yeah,
anybody listening to this podcast maybe doesn't know you from Adam. So
sure.
what's your incentive? What's Equity Check's incentive? And so how do we make sure those are aligned with the investors you're working with?
Yeah, it's a great question. So what we do at Equity Check is we ensure that we're in the same boat as the investors. And so the first thing that we look for, we have a really, really simple framework. And there's of course DD due diligence that happens beyond this, but this is a very quick and easy way to go, yeah, we'll take a further look at this, or no, thank you. And the very first one, it's alignment, asymmetry, and accountability. The very first one that's like, if we don't, this box isn't checked, do not pass go, do not collect $200 is alignment of interests. And so really what we look for in the easiest way to ask the question is, when does the sponsor win? Do they win when they make the acquisition, or do they win after the investor gets their money back and gets a meaningful return on their capital? And if the sponsor is incentivized to make acquisitions with big fees on the front end related to, deal fee, marketing fee, uh, guarantor fee, KP fee, I've seen so many deal structures where on the front end the sponsor makes millions of dollars on the day they purchase it before the investor ever gets a distribution. And so that is the very, very first thing we look for. And if it's weighted, in any significant manner on that front end, if they're winning before the investor does, then we just go no, because no matter how smart they are and how great of an operator they are, you've got a misalignment of incentives. And then so what we do is we structure, to the best of our ability, we structure our compensation to align with the investor. So we obviously want to have our costs covered and make a decent income, but really we want to be in that seat with the investor where we win when they do.
Interesting. And so you're
Mhm.
getting paid by the investor, or are you getting paid by the sponsor?
See, that's the beauty of it. So one of the things that we insist on is that working with us will never be dilutive to the investor. So whether they go directly to the sponsor or they invest with us, their return is going to be the same. And the sponsors typically don't have a marketing presence. They don't have a podcast. They don't have an investor relations department. And so we've very strategically gone to these folks, most of the time who it's just been the founders that are doing the capital raising, and shared with them what we're doing and what our vision is. And they've said, hey, for your collaboration with us on this deal, we're basically going to reduce our compensation in order to compensate you for investors that you bring to the table.
Okay. All
Hmm.
right. Well, that all sounds great. But again, if I know you, so I know
Hmm.
the answer to the question, but I'm going to
Yeah,
ask on behalf of all the listeners who don't
yeah.
know you, what's to stop you from taking a bigger payday from a syndicator that maybe doesn't check all the boxes, but they're going to buy you a new Lamborghini next year?
Oh, a Lamborghini. I'd be laughed out of Asheville if I drove a Lamborghini. Maybe a killer home sauna, um,
There you go. Yeah.
or a camper van. Um,
Yeah.
yeah,
Killer
great.
sprinter. Yeah.
Great question. So, I mean, I think what we quote sell when we talk to investors is exactly what I shared with you. And so every single opportunity we present to them before we ever talk about the deal, we go through each one of those pieces. And so it's going to be really hard for us to bring to them a deal that has, a 3% acquisition fee on the front end, or uh, has a bad incentive structure. But then the second piece of it is I have offloaded the decision making to a committee that understands our core values and is committed to upholding them, even if for some reason I get swayed by the Lamborghini or the metaphorical Lamborghini. And so I have that initial conversation. And for me, it's really a gut check, because any sponsor that we go and raise capital for, this is somebody that I want to work with for 20 and 30 years. And so I'm going to have that first conversation to say, hey, I like these guys. Do they pass the sniff test? Do I believe in what they're doing? And then from there, it goes to a group of people that deep dive into the thesis, into the economics, into their background and their track record. And and then it really is, it's outside of my hands to the degree that we want unanimous, yes, this is aligned, this is a great offering, there's an extraordinarily low likelihood of this losing money, and a well above average likelihood of this delivering above average returns for our investors.
I dig it. I guess the other thing that you forgot to mention, which I'll just go ahead and be so bold as to mention on behalf, is that the world is a very small place and the internet moves information very quickly. And so
Hmm.
you are staking these claims on what you just shared, but also your reputation. And
Yeah.
if you burn an investor, everybody is going to know about it the
Hmm.
minute it happens.
Yeah.
And so I think that's important also to highlight is that you have a lot of very satisfied clients. And should that change, we will all know about it overnight.
Yeah, and look, I mean, I think absolutely, absolutely, and I think that's actually, there's this last market cycle that I talked about where a lot of passive investors did get burned. It's deeply unfortunate, and out of that, there are platforms that are emerging to provide more clarity about how sponsors are actually performing and how investors are actually being treated. And that's a beautiful thing. I mean, to have some sort of objective platform or forum where you can go and say, XYZ sponsor, how have they performed? What do people think about them? And
Yes.
yeah, I think it's a great point, and it's necessary. I mean, that's the challenge with the private markets, or has been the challenge historically, is there's not the transparency and the level of detail and reporting that if you're going to invest in Apple or Google or Tesla or whatever, they've got quarterly calls. They've got to present a ton of information on an annual basis, so you know exactly how that company's performing. But in the world of private investments, the burden is on the sponsor to report as much and as frequently as they want to, and that's why we have that
Mhm.
third tier of accountabilities. We insist on that from our sponsors, but having those objective review systems is also extraordinarily beneficial.
That's great.
Mhm.
That's great. Well, Andrew, I'm curious to know of all the deals that come across your desk and you see percentage wise, I mean, what would you say? How many are in the green checkbox opposed to the no, we're going to pass on this?
Less than 1%.
What? So you'll see 100 deals and maybe one you're going to push the equity check stamp of approval on.
Yeah.
So crap, man. So everybody listening who's like, oh, I've invested in 5 or 10 syndications. I mean, that's remarkable. So that's exceptionally low. And I know you, and I was not expecting that. That's lower than I was expecting. So everybody is catching my reaction live and organically. So where of those three check boxes that deals tend to get kicked out of, are you seeing most of the offenders? Is it because they're taking too big a fee and the incentives aren't aligned? Is it because there's no accountability? Talk to us about where, if there is a typical offender.
It's almost always either one or two, and so the framework is very, very purposefully goes in that order, again, because I think just the incentive piece is at the core of just how we function as humans. And so, like, to expand it out a little bit, one of the things that probably everybody remembers to one degree or another is the 2008 financial crisis. That the core of that was something called moral hazard, meaning there were large investment banks and the whole financial system was gambling with other people's money with no consequences whatsoever. A lot of people have watched that movie, The Big Short. Like, one
Mm-hmm.
guy went to jail, most of the CEOs, still got their big bonuses. The people that were
Mm-hmm.
impacted and hurt the most were individuals in that people that lost their homes, people that lost their jobs, etc. And it's the same principle when you have a misaligned incentive structure, where just how we function as humans is, if I'm going to be rewarded for doing X, typically I'm going to find a way to do X. And so if you're getting a big payday every time you acquire a deal, then you're going to do whatever you can to acquire deals, and all sorts of like rationalizations, all sorts of cognitive biases, all sorts of bad thinking come into that, where you cherry pick data, where you only pick out facts to include in your underwriting that support the reason to buy that property. You're going to get riskier debt. You're going to ignore things like, income is not at all pacing with rent growth. There's been no time in history when rent growth has consistently grown year over year at this, at this pace. Interest rates have been is low for far too long, and it's highly likely that they're going, like, there's all these things that if you look back at what happened in this last market cycle, you can go, oh yeah, well, that's obvious. But when you have this incentive structure and you can buy a Lamborghini every time you close a deal, it's going to be a lot easier to do that. So most get kicked out at that point, because not only is when somebody aligns incentives properly and prioritizes investor interest, not only are they saying, hey, we value you, we value your trust in us, but also what they do is they're signaling their confidence in the acquisition. Because if they don't make money until the investors make money, until that deal performs well, they're going to really dot their I's and cross their T's in the due diligence process. And the best story that I have for this has actually happened really, really recently. There's a group that we work with. They're a top 10 multifamily operator. They've been in business for 24 years. They have 83 round trip deals. 18.5% average IRR net to investors over that time period, and they've never lost a dollar of investor capital. And their incentive structure is extraordinarily aligned with investors' best interests. And they recently backed away from a deal where they had $1.5 million on the line in earnest money, not to mention their DD costs. So they took a personal hit, the firm, not the investors, of roughly $2 million, because they realized throughout the course of due diligence that the seller had been giving them incorrect information. And so their underwriting was just not as conservative as they thought, and they didn't have the degree of confidence that they did initially, that the property was going to perform well and meet their targeted returns. So they backed away from it, and they went back to the investors and said, hey, we're so sorry, this is what happened. And they returned money to investors. They were fully funded for that project, and they said, we're just not confident in this deal anymore. And so that is a perfect example of why having aligned incentives not only is why that's so powerful, because it literally changes how you think as a sponsor and operator. And so that's the first thing. Most people get kicked out there. The next piece is the asymmetry piece. And so we look for long track records. We want to see people typically that have gone through multiple market cycles have a really, really clear competitive advantage as to why they can operate in a more in a stronger financial, where they can produce stronger results. If it's a multifamily value add operator, well, what makes you different than the 500 other groups out there that are doing Class B multifamily value add? And typically that's time and space, that's market knowledge, that's vertical integration, that's reputation. There's a different things that can, that contribute to that. But again, go back to Uncle Warren Buffett. He called it the circle of competence, knowing what you know and knowing what you don't know. And typically the longer somebody is in a space, the more they understand the territory and they're able to operate in a more effective manner. So usually it's those two things. And if people that check those boxes, then they have no reason not to be accountable. They're happy to share audited financials. They've already developed an excellent organizational structure, and they understand that trust is hard to it's hard to build, and it's easy to lose. And the way that you build and maintain trust is by being hyper communicative, very detailed, clear, and transparent, even when things are going poorly. So I hope that answers your question.
No, it does. That's awesome, man. That's awesome. So I'm curious to get from your perspective, because we've had a lot of syndicators on the show, a lot of sponsors on the show, and I always love asking them, what should people look for when they're evaluating a deal or evaluating a sponsor? But that's kind of asking like a barber if you need a haircut. So I'm curious to hear it from your perspective, because you're outside of that world now, obviously in it, but not working as one or for one.
Yeah.
What is it that people who are not working with equity check but want to invest passively in deals, what should they look for? Because you have an entire team doing DD on your behalf. These people may just be one-off individuals. So how could they possibly be doing this on their own? What should they be looking for?
Yeah, great question. I mean, I think that's that in short, the DD that we do is after somebody's already has already gone through that very simple framework. And so you as an individual investor, you can like literally in less than 5 minutes, you can decide whether you want to invest. I mean, you can decide whether you want to do further DD. So there's all sorts of DD questions that you can ask. You can look at you can do background checks. You can look at all sorts of metrics, yield on cost, and you know debt structure, you know pro forma assumptions. I mean, you can get into the nitty gritty as much as you want on the underwriting, but I think objectively, any LP that is any passive investor that's considering going into a sponsored deal, again that like the alignment of interest and the way that you solve for alignment of interest is really just the fees, and it's when does the sponsor win? If the sponsor wins when they acquire a deal, our thesis is pass. So you want to see investor wins first, then the sponsor wins, and that doesn't mean they don't make anything. They need to eat, they need to support their team. But if they're getting rich, if they're making Lamborghini money, to use your illustration on the front end, then that's a pass. Second is time and seat, and really being able to discern. What you'll see a lot now is people claiming, "Oh, we have 750 million AUM, 3 billion AUM." Do you have 3 billion AUM, or have you co-GP'd with a sponsor that has 3 million AUM and raised
Mm.
a couple million for a few of their deals? Or are you counting your LP investments? So if you put $100,000 in a $80 million apartment syndication, are you saying, okay, I mean, that happens all the time, happens
What?
all the time, where people will claim deals that they're LPs in that they have no operational responsibility whatsoever.
Wow.
They'll claim AUM for deals that they've raised a very small amount of capital for, and so you really have to. That's very easy to suss out. I mean, you ask the question, you can do a little bit of research and go, oh, okay. This is somebody that's raising capital for the first time, or is very new and is basically claiming somebody else's track record as their own. Um, and then I think those sites like Invest Clearly is one that I know of. Passive Pockets is another one that I know of. Those seem to be. I'm not endorsing either of them because I don't have any affiliation with them. But those seem to be. Those seem to be objective. They don't seem to have any misaligned incentives, and I think those are great places to go and doing a simple Google search as well. And then the last piece I think is like show me your reporting. And I actually just created a prompt, and I'm happy to share it with any of the guests if they just ping me on LinkedIn. I created a chat GPT prompt where you can drop in the pitch deck, the sub docs, and the underwriting, and you can run it through that framework, and it will spit out less than, I mean, 5 minutes or like a minute, and it'll tell you, are the incentives aligned? What is their actual experience level, and you know those key factors, and then you can make a decision um, on your own. But it's actually relatively simple,
That's
and that
awesome.
works whether you invest with us or not. I mean, that's how I make my decisions, and I learned that the hard way because I had to ask myself, of my investments that didn't go well, what went wrong, and it was it was those three things.
Yeah, I was just gonna ask you. So, I mean, you see 100 investments pass on 99. Do you ever keep tabs on the ones that you're like, oh, this is gonna be really bad, to see if your gut was right, and if so, what makes it so bad?
Good question. It's hard to because again, you don't see the stock price drop. You don't
It
see
doesn't get
the
reported,
it doesn't get reported, and so nobody's advertising like, "Hey, this deal went to crap, and I had to do capital calls," and and so
right?
it's
Right.
hard to know, and I'm really hopeful that there will be an increased level of transparency there, and I know that there's a lot. I mean, I think in this, as we evolve technologically, I know there's people working on really innovative ways to track those things. But I hear it from investors. I talk to investors all the time, and I hear enough stories now too where I go, "Oh, I know who they're talking about." So yeah, I wish I could. I wish I could have a little ticker symbol up on my wall, and I could check in every 3 months to see. And Look, sometimes I'm wrong. I mean, Buffett famously got a lot of flack for staying out of tech stocks, and but he just said over and over again, it was just I don't understand it, and so he continued
Hmm.
to invest in things he understood, and so I'm sure of those 99 that I passed on that some are good deals. I don't think they're all going to perform poorly, but it's really just for me to be able to sleep well at night.
Right.
Yeah.
Right. No, that makes a ton of sense. Well, Andrew, this has been awesome, man. As always, if people want to learn more about Equity Check, invest with you, get that prompt, where's the best place for them to get in touch?
Yeah, they can go to equitycheck.com. There's a really simple form there they can fill out and they'll get connected with me. Or I'm pretty darn active on LinkedIn as well, so they can find me there. Just Andrew Davis Equity Check, and my profile will pop up. And hopefully by the time they talk to me, I won't sound so nasally.
Right on. This has been a ton of fun, man.
Yeah,
Definitely excited to see where Equity Check continues to go, and
thank
we're going
you.
to be in touch.
Awesome.
Take care, man.
See ya.
All right, everyone, that was our show. A big thank you to Andrew for coming on. Really a wealth of knowledge. He's been in the industry a long time. He knows what he's talking about. And it was so refreshing to hear his take on syndications and a lot of poor ones that had come across his desk. And as always, ratings and reviews are really helpful to help us reach a bigger audience base. We love hearing from you all, and we look forward to seeing you on the next one. Happy investing.